Well, good afternoon and welcome to our High Rock clients and any other listeners who have joined us this week. And thanks for taking the time to tune into our weekly webinar where we will be talking about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Okay, let's quickly recap our themes for 2016 before we get started on what happened last week. Now, our overriding theme, as you all know, for 2016 is that financial markets will remain volatile. Well, January and early February saw a spike in volatility, but markets settled a bit in late February and continued to be less volatile at the moment, thanks to the continued monetary stimulus by central banks. But we are only 1/3 into the year and far from being out of the woods on the volatility spectrum. Well, the big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer is not, at the moment, providing a significant lift to the domestic economy as had been hoped for, despite improving employment growth. Now, expectations for the first quarter of 2016 are showing almost no growth at all. Don't forget, the 2 consecutive quarters of negative growth would technically be classified as recessionary. Commodity prices, and especially oil, are trending higher now after a prolonged decline. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks considering their next steps. The European Central Bank, the Bank of Japan have pushed rates into negative territory to try to get the value of their respective currencies lower and attempt to drive their economies into growth through exports. This has backfired somewhat as the U.S. Federal Reserve has pulled back on their desire to push rates higher, at least for the moment, and a battle for lower currency values has begun. It has become apparent that the limits of monetary policy may have been reached. Geopolitical wildcards like the UK leaving the European Union, the U.S. presidential election campaign, Saudi Arabia and Iran, OPEC and other oil-producing nations, China, North Korea, terrorist activity, and the refugee crisis are all increasing the levels of uncertainty, and it is uncertainty that does ultimately create volatility. We continue to watch bond markets for clues, and as we move further into the first quarter earnings season, expectations continue for a 4th consecutive quarter of negative growth. The last time earnings growth had 4 consecutive quarters of negative growth was the period of 2008-2009. Now, investor sentiment is low, yet stock markets have moved to within small percentages of their all-time highs, making them, in our estimation, even more expensive. We remain in a time of lower than average returns when after 6 years of above average returns, and as the cycle evolves, longer-term returns are moving back toward the average. The total return, including dividends on our benchmark all-country world index is about a -6% over the course of the last year. The total return on the Canadian bond index is a positive 0.5% through that same period. Meanwhile, our client portfolios continue to perform better than any combination of those 2 benchmarks because we continue to find value in rebalancing client portfolios to take advantage of opportunities as they arise. Okay, well, let's have a look at what's been driving markets over the last week. It was a wild ride in January and part of February. However, volatility eased up through March and April as the People's Bank of China, Bank of Japan, and the European Central Bank added further monetary stimulus, and the U.S. Federal Reserve lowered expectations for higher interest rates. Volatility remains below its long-term average. CNN Money's Fear and Greed Index had a low near 9 in January, but has moved back into greed territory as the more stimulative central banks have forced money out of low and negative yielding safe assets into riskier assets. Markets moved rather quickly from oversold to overbought in March. We suspect that the next move may actually take us lower. Well, since our last webinar, our benchmark world equity index is lower by about 0.8% and is now up about 2.8% on the year. Japan's Nikkei 225 index was the best performer since last Tuesday, and China's Shanghai Composite Index was the worst performer. Our strategy for 2016 to be overweight the Canadian equity market and underweight the U.S. equity market for rebalancing purposes got to be so favorable that we have now taken the profit and rebalanced it back to an even weight. On a total return basis, which includes dividends and currency fluctuations, with the TSX up by about 6% and the S&P 500 in Canadian dollar terms lower by about 5 3/4, a net difference of about positive 11 3/4% in our favor. The trade worked very nicely. That is how active rebalancing can add value. The TSX has been the best performing country index in the developed world this year, and the Canadian REIT index has also done very well. We have an allocation to the REIT asset class in our global equity model. Well, after hitting highs last May near 63, our benchmark world equity index made new lows near 49 in mid-January, and then again in early February, which is about a 22% drop from the highs, before it found buying support from short covering and a little bit of value investing after such a steep decline. At the moment, the top of the down channel has been broken to the upside as buying has driven prices higher, and the next test of selling resistance should be up near the 58-59 level. Now, the new uptrend channel shows support at the 57 level, which now appears to be being tested. So we're watching buying support come in a little bit there. We'll see if it holds. Trading volume continues to remain low. And without volume follow-through, it will be difficult for the market to sustain any upward momentum. Now, as we enter earnings season, expectations were quite low, as was investor sentiment, and short positions were put into place. The jump in oil prices and slightly better than expected earnings thus far has initiated a little bit of buying relief and some short covering. The trend may be changing, but we need to definitely see confirmation of that in all of our value metrics before we become inspired buyers. In the fixed income world, Canadian high yield bonds were a little bit higher this week, playing some catch up to the U.S. high yield. U.S. government bonds were lower. U.S. and Canada 10-year yield spreads narrowed even further this week to 36 basis points from 46 basis points last week. They were as wide as almost a full percentage point back in January. So better Canadian economic data, higher inflation data in Canada, a stronger Canadian dollar, all of these adding to the reasons for Canadian yields rising more quickly than U.S. yields. U.S. yields rising less quickly because of the economic circumstances prevailing in south of the border. Well, as I said, the Canadian dollar has also benefited from narrowing interest rate spreads and is now closing in on the 80 U.S. cent level. That certainly won't make the Bank of Canada happy, but snowbirds, you should all be out there locking in your U.S. purchases for next year. Oil prices were a bit higher this week. The oil market continues to move higher within the new uptrend channel. Shrinking oil supply expectations are the main driver of oil prices at the moment. Also, the Bloomberg Commodity Index continues its uptrend. Well, our benchmark World Equity Index is comprised of about 53% of U.S. companies, so we keep a very close eye on what is happening in the U.S. economy, and we think that it is starting to look a little bit scary. Now, the U.S. Federal Reserve modified their expectations for higher interest rates in March as economic conditions remained under pressure. The Fed will announce their latest monetary policy decision tomorrow. It is unlikely that the Fed would ever mention the increased chances of recession because they want to keep the optimism in their outlook to keep the general public from becoming concerned. However, they will be concerned that the consumer is not spending. The consumer is 2/3 of the U.S. economy. I know I mention that almost every week. And they will also be concerned about today's report on April consumer confidence showing a drop. Consumer confidence has been slipping since the middle of 2015 despite better employment growth. The gap between consumer confidence and spending has also widened. Industrial production has been declining since the end of 2014. Durable goods orders for March rose, but at a pace that was considerably less than was expected. Expectations for the first quarter GDP are at roughly 0.4% growth rate. The latest data have all been taken into consideration there. Remember that a recession is defined as 2 consecutive quarters of negative growth, and at the moment the first quarter is running only slightly above the zero line. We'll see a little bit more later this week. In fact, on Friday, I believe, or Thursday or Friday, of the first quarter GDP's first estimates coming from official sources. So we'll be watching that closely. Well, last week, the April Philadelphia Fed Business Outlook Survey reversed its March increase, and notice that the 3 previous recessions followed steep drops in this survey's results. So there's something that we are watching closely and are quite concerned about with the outlook and the potential for recession in the U.S. As we mentioned a few weeks ago, another indicator of previous recessions has been the direction of the ratio of coincident and lagging economic indicators. This has continued its downward trajectory with the most recent data, so raising further recession concern here. As we have pointed out before, corporate profits have historically turned lower preceding a recession. Corporate earnings growth has been declining in the previous 3 quarters and is now expected to fall in the first 2 quarters of 2016. That would be 5 consecutive quarters of declining earnings growth. That is something to be concerned about. In their World Economic Outlook update a few weeks ago, the IMF suggested that the probability of the U.S. recession had increased. We think that it has increased further since then and has a greater probability, perhaps closer to 50%. Our indicators are certainly pointing in that direction. Finally, if we look at the history of U.S. interest rates, the times when the 2-year, which is marked, the 2-year bond is marked in yellow, the 10-year in green, and the 30-year in purple, when those yields are the widest apart, it reflects the most positive sloping yield curve. When the Fed raises rates, the 2-year yield rises considerably more quickly than the 10 and 30-year yields, which flattens the yield curve, and typically a recessionary period ensues. Now, at the moment, the spreads between the 3 maturities remain relatively wide, but if the Fed raises rates, as they say they hope to 2 more times this year, then the recession probability is going to move higher. It has also been 7 years since the last recession, so from a timing perspective, we are definitely getting closer to the next one. The recession need not be deep, nor do we see anything as ugly as the 2008 financial crisis, but austerity at the fiscal level and the inability of U.S. politics to find the compromise somewhere in the middle is definitely taking its toll. Okay, so let's have a look at what's going on elsewhere in the global economy. After all the monetary stimulus from the European Central Bank, the Bank of Japan, and the People's Bank of China, we are still waiting to see some results. In the meantime, the International Monetary Fund once again lowered its global forecast. The world economy will grow at a rate of 3.2% this year, down from a projected 3.4% in January. The IMF said in its quarterly update of its World Economic Outlook. Well, the broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performances covers close to 2,500 constituent companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. The U.S. has more than half of those companies. Europe has about 16%, Japan about 7.5%, the UK has about 6.5%, Canada has about 3% of the companies, and China about 2.5%. So all of those situations we watch closely. Well, in the euro area, the March Consumer Price Index data remains well below the target 2%. The European economy remains relatively stuck. The Bank of England held monetary policy unchanged at their meeting a couple of weeks ago, but indicated that there were growing risks as a result of the referendum on which to remain in the European Union, which we know as Brexit, which will that referendum will be held on June the 23rd. The sentiment appears to be spilling over into the consumer as retail sales continue to decline. In Japan, the latest reading on manufacturing for April slid further, and China's economy continues to slow. Well, here at home, in the latest interest rate decision, the Bank of Canada reiterated that the oil price shock continued to weigh on the Canadian economy. The first quarter GDP growth appears to have been unexpectedly strong, but some of that strength is due to temporary factors and is likely to reverse in the second quarter, according to the Bank of Canada. Slower foreign demand for growth and the higher Canadian dollar being the focus, or the key, being the key factors. Business investment is still shrinking due to sizable declines in the energy sector. The combined effect of all of these global and domestic developments would have been a modest downgrade of the bank's outlook. However, the fiscal measures announced in the March federal budget will have a notable positive impact on GDP, according to the Bank of Canada. So the bank now projects real GDP growth of 1.7% in 2016, 2.3% in 2017, and 2% in 2018. Not spectacular growth by any stretch. Canadian CPI was higher in March. Food and alcohol were the key contributors to that. Clothing and transportation were declines. And this brings the core inflation back up to or just above the Bank of Canada's 2% target. So what do we see on the horizon? Let's check in with the bond markets. Each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, the UK, and Canada, should give us some hope of better economic conditions in time, as investors want to receive greater returns to protect themselves against future inflation. And that's assuming that it is growth that is causing that inflation. Negative yields, which would be below that red zero line, indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese curve is now negative out to almost 15 years. In essence, you'd be paying to own the safety of Japanese government bonds as opposed to them paying you to borrow your money. And that yield curve has flattened somewhat further. Not a good sign for the Japanese economy. US, UK, and Canadian yield curves have steepened marginally this week as inflation data suggests that bond investors need a little bit more protection at the farther end of the yield curve. In a rather frightening turn of events, U.S. high-yield bonds have followed equity markets back to close to their highest levels as investors are now chasing risk to get higher returns. But the less volatile Canadian high-yield market continues to lag the U.S. market. And there's still concern for risk of an increased risk of defaults in the energy sector, and there is a spotlight on massive energy loans. Last for equity markets, some investors are still buying stocks, driving prices higher as they seem to be quite comfortable adding to riskier assets, riskier assets to their holdings. We are not, and here's why. Now, when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. Now, the 12-month forward price-to-earnings ratio is currently at an expensive 16.9. Last week it was 16.8, so it's up a percentage point or a basis point. At the equity market highs back in May of 2015, it was at 17.1. Now, given the economic circumstances and the uncertainty at the moment, it is really hard to justify buying expensive stocks at the moment. It is earnings season, and the result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is now a negative 8.9%, which is below the expected earnings growth of 0.3 at December 31st of 2015. It will be the fourth consecutive quarter of negative earnings growth. Now, on average for all of 2016, analysts are projecting earnings growth increases of only 1.1%. Beginning of this year, only 3 months ago, analysts had projected 2016 earnings growth of closer to 7.4%. That is a steep downward revision and further echoes our concerns at the expensive level of stocks at this particular moment. Last week we talked about how many companies purposely lower estimates so that they can announce results. They look like they beat, so that they can look like they beat the lowered estimates. On average, over the last 5 years, 67% of companies have beat estimates. We are early into reporting season thus far, with approximately 26% of companies having reported, and 75% of those 26% have beat estimates, so a little above the average. Now, the S&P 500 and our global benchmark all-country world index appear to be finding something positive here. For us, this is only slightly ahead of expectations, and we are further concerned by the increased downward revisions to future expectations. Recent rally in stocks has pushed the enterprise value to earnings ratio higher, back above 13 times and well above the longer-term average. Stocks, again, looking expensive. Corporate profitability, which is the white line, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time. In fact, it looks like an elastic band that has been stretched too far. Investor sentiment has risen a little this week, but the gap between investor sentiment and stock prices remains very wide. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell, so margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. The most recent data show that this trend is continuing and keeps us very cautious. When the spread between large cap markets like the S&P 500 widen over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. When markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied more, while the broader Russell 2000 has lagged. This also does make us cautious. So while the S&P 500 has tried to move up through the top of the downtrend channel, volume of trade has not followed the move higher. And as I said before, without volume follow-through, markets are suspect. So what does it all mean for us? Well, since last May, as you all know, we've taken a cautious and defensive posture to investing, and in light of our key theme for 2016, we remain defensive because we are not convinced that with all the economic data currently on our radar screens and all of the metrics that we monitor to determine if there are buying opportunities, which we present to you here each week, that there is good value in today's equity markets. Until we see otherwise, we shall continue to be patient and let others chase what we believe are expensive asset prices. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HighRock will dictate the minor adjustments in short-term strategies that we make in our models, which we believe add value to the long-term performance. That is how we justify our fees. On BNN's market call last evening, Paul identified 3 top picks for our models. You can see the entire show by clicking on the In the News tab on our website, or visit the link to the Globe and Mail's Globe Investor article. Our clients will have exposure to these picks depending on timing and value as we see fit, and of course in keeping with your long-term strategy. Well, our HighRock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies, because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in client accounts, the underweight exposure to equity markets, and the exposure to safe government bond markets helps to mitigate the impact of volatility on our portfolios, and that is why we are able to be better than the benchmarks, as I mentioned before. Our tactical model has taken advantage of some value purchases so far this year, like buying Rona before it was taken over by Lowe's, a nice 100% increase, and picking up cheap shares in Paramount Energy before it tripled in price and we sold it. With all of this with significant cash weightings, and this is how we can add value to our clients and our portfolios and get growth with the best risk-adjusted returns that we see possible, and meanwhile stay ahead of the returns of our benchmark indices. Okay, well, what's up for next week? As we enter tomorrow, we'll see, as I mentioned before, the U.S. Federal Open Market Committee, that is the U.S. Fed rate decision. We'll see the first quarter GDP out of the UK, and we'll see some Japanese inflation and industrial production data for March. On Thursday, as I mentioned, we're going to see the first look at U.S. first quarter GDP, expected to be somewhere between 0.4 and 0.6% growth rate. Japan will also announce their pardon me, small technical difficulty. In Japan, the Bank of Japan will announce their interest rate decision. On Friday, we're going to see March consumer spending out of the U.S. and personal income data as well. We'll also see the Fed's targeted inflation index, the core personal consumption expenditure price index. We'll also get Euro area first quarter GDP and Euro area April inflation data. On Saturday, we'll get the first look at the latest Chinese manufacturing data. And then on Monday, we'll have U.S. April manufacturing data. And then, of course, next Tuesday, please stay tuned or tune back in for the latest HIROC webinar. As I've mentioned for the last couple of weeks, just on an administrative note, you all may know, but I shall repeat it as a reminder that our communication process is wide open. We send out quarterly reports, insist on at least semi-annual reviews, have these weekly webinars, and write blogs which are available on our website. However, we also encourage you to contact us if there is anything you wish to chat about, be it strategy or a change in your circumstances. Now, there are very few, if any, portfolio managers who offer this level of service, so please, please take advantage of it. Okay, I've gone well over my allotted time for today, so I'm going to not have the question and answer period, but if you do have questions and wish to email us, we would be more than happy for you to send them. We also love to get your feedback on these webinars, what you think is good, what you don't, what else you might like to see us cover. As always, thank you very much for taking the time to tune in. Wishing you an excellent rest of the week, a great weekend, and don't forget to tune in next Tuesday. Until then, this is Scott Tomlinson signing off.